I'm going to tell you the UK stocks that I'm buying right now, as well as update you on the market commentary such as Twitter, such as Alibaba, as well as ASOS and Dunelm Group. So if you like this video, please drop one of these to help beat that YouTube algorithm. It is much appreciated. So when we first jump into the news, we have actually got Elon Musk offering to buy Twitter for $41 billion. Now, initially he held roughly a 9% stake, and then he was offered a seat on the board, which he accepted, to then go to the board and then be rejected or decline the position. This then hinted at the idea that he was looking to take over the business as if you were a director of the board, or if you were on the board of directors of Twitter and you had a stake limit of 15% only. Therefore, since he's looking to buy the company, he obviously refused the seat and then offered this. What I found quite amusing is the offer. Now, $54.20 per share, but it's the fact that he slipped in the 420, which is the old 420 blaze it kind of joke, and it's just another thing that typically Elon Musk would do. Now, I think this will happen. I think he will end up owning Twitter, and I think it's an excellent source of marketing for his brand. And again, if he promotes free speech, then feel free. I think that's a net positive in the world, and I think that's a really good sign going forward. However, I do think Twitter itself, the business, isn't that great. I don't think they really can generate that well of returns, and I think they were actually losing money in their last financial trading update, so that would be a little bit more of a concern for me. But if you took the business private, maybe something interesting may just happen. But it's certainly an interesting move by Elon Musk, and something that is no doubt going to continue to get him publicity, even if he decides at the end of this he's going to sell his 9% stake, because it's likely he's already made a profit on this due to the hype behind him. And whenever something has Elon Musk's name by it, suddenly a lot of people are interested. You've got all of these fanboys that just jump in behind and join the bandwagon. We've also got Dunelm Group. Now, this is one of my holdings in my SIP, which is my free trade SIP, and I've only got a very small sum of money. However, I thought Dunelm's results were quite impressive. Now, unfortunately, their comparison periods compare back a year and 2 years, which a lot of businesses are doing, although in the 2 years ago region, what had happened is at the very late stages of that period, we unfortunately had seen obviously the pandemic. I was trying not to say the name of it there just in case, and effectively in this time they've still done quite well. So a 2 year over year trend of the quarter 3 is a 40% growth over what it was in 2020 in terms of total sales. They've seen their digital sales since that time increase by about 12 percentage points. However, it is currently sitting at roughly 35% of digital total sales, which I think is a very good balance. And I imagine across the board, it's likely a very stable trend. It does seem that consumers are very much more weighted to going into stores. And if a company offers multiple different ways of being able to provide a transaction, it's likely that they are obviously going to go into stores. And you may be asking, well, you own Boohoo, so what's going on there? And I think that over time, this is certainly an increasing area, even though year to date, the digital total sales has actually decreased, and over year, but that's mainly because of the influence of the pandemics and the lockdowns meant that digital sales were the only form of stream, or very much had a great advantage. But it seems like Dunelm Group's doing quite well. But one thing I didn't like to see is the fact that they had a net cash position of £40 million this time last year, but now they have a net debt position of £14 million, and they continue to pay out dividends. I'm not very happy about this because they have obviously chucked out £75 million in a special dividend and furthermore. And yes, I do like companies that pay dividends, but I do want them to have some cash available and not just throw themselves needlessly into a bad position, as it is going to lower the value of the business. Now, we've also got Charlie Munger. Now, if you don't know who Charlie Munger is, I don't think you'd be watching this channel, so I'm going to assume you know who this gentleman is. He has slashed his stake in Alibaba stock with the Daily Journal. So now he was the chairman of the Daily Journal, and they have a portfolio of roughly $200 million of assets in the stock market, which is invested, right? Recently, on March 28th, he had actually relinquished chairmanship and is now just a director of the company. Interestingly, in this time, they have managed to slice their Alibaba stake by 50% as far as I'm aware. So they have very much reduced this. And Charlie Munger is someone who very much preaches the idea of if you have conviction in the investment and if if it's a wonderful company at a fair price, and certainly buy. And that's why in this situation, I don't believe Charlie Munger is actually deciding that he's going to sell. I reckon the reason behind this could be one of two things. Firstly, it's an ADR, an American Depository Receipt. This effectively is something that means that they can invest in these shares even though they are truly domiciled, I'm guessing, in Hong Kong or wherever Alibaba is actually domiciled. So in this situation, they may have transferred from ADRs to HK security listings, which would have therefore made it look like this had their stake removed. Or, in this situation, what happened is the Daily Journal had done a risk assessment based on their balance sheet and decided that actually, based on the assets of the company and the proportion of their assets invested in Alibaba, that this was a concern and therefore a risk towards shareholders, and therefore they had reduced the stake. Because over the last year, they have very much been doubling and tripling down on the investment as it continued to fall, and I do believe it has continued to fall since, and I think overall, on their first investment of roughly 150 or 165,000 Alibaba ADRs, they would be down roughly 50%, or they would only have £18 million worth left. And they haven't actually changed any other holdings in the first quarter, as they hold 2.3 million shares of Bank of America and 1.6 million shares of Wells Fargo. So I'm wondering, what do you think is going on here? Do you think it's very much Charlie Munger's choice to reduce and cut down this position? But then again, I very much don't think it's in his nature. I personally believe that if you're going to sell a stock for whatever reason, and it's not for taking profits, then I do believe that you should take it and make a firm decision to say, you know what, I'm going to cut this position entirely and sell it. In this situation, they still have hopes it's going to rise further because ultimately you're in the stock market to make money. But therefore, I think they are overall just reducing their risk for their shareholders. Now, the comment of the week this week was by the Breaking Bad himself, Mr. Walter White. Bro, you are living in a delusion. I lose my money because I have a job and can rebuild my lost fortune. How about not lose it in the first place, LOL? Well, okay, that has been taken off already. What I meant is I have a long career ahead of myself, and I think there is a direction that I can go, and that I will have an income going forward for the next 20 to 30 years, where therefore any losses I make now whilst I'm in my discovery period and trying to learn and absorb as much information as possible in the stock market, that I can therefore leverage that knowledge and therefore use the advantage of that I'm going to continue earning money in the future, well, hopefully, and therefore use that so that if I am making what would be seen as a large percentage loss of my portfolio at the moment, over time, as I expect my annual income to increase and my knowledge in the stock market to increase, and my returns overall will do well longer term, and that I'm not fixated on the short to medium term motions. Now, just consider the following: increasing shipping costs and bottlenecks, higher parcel delivery costs, higher wages, rising rates for retailers, warehousing, smaller share of online shopping due to the lifting of restrictions, Brexit red tape, competition from ASOS, Shein and Primark. Boohoo is worthless. Stop buying this garbage. Why does this single out Boohoo? I think a lot of these are going to impact a lot of businesses in the environment, and therefore Boohoo singly being valued down is incorrect in my opinion. If there's increasing costs by shipping and also bottlenecks, that's going to impact many distributors across the world, and it's going to create a knock-on chain reaction effect. Yeah, well, your business might not be shipping, but you might be buying a service from another business, and that business that you're buying a service from actually is a majority of its revenue comes from one of these that imports a load of goods into the country, and therefore these shipping problems are going to hit them, and it's going to hit across the chain. They're going to be buying less services because they're cutting back on their budget, causing potentially a recession. Again, I'm a little bit out of my depths in that explanation, but again, a lot of these are going to impact many different businesses at once. This does not single out Boohoo. You might go, well, rising rates for retailers' warehousing, smaller share of online shopping due to the lifting of restrictions. That is to be expected. And yes, during the pandemic, Boohoo and these online retailers were put to a very, very high valuation because they had a significant advantage. They were open when the high streets weren't, obviously. But now it is to be expected that the high streets are going to do something best. But again, this is something that I expect. I want competition, and in fact, Boohoo is opening their own stores anyway, Debenhams.com in Manchester, so again, that's different. Furthermore, competition from ASOS, Shein and Primark. Well, funny you say that because ASOS have actually released their results for the 6 months to February 28th, and guess what? they're not really that great. They've seen their group revenues grow by 4% at a constant currency basis. I'm looking at CCY change here because it reflects a fairer estimate of the raw growth of the company, but they've seen significant declines elsewhere. Once before, they had 110 million pounds of operating profit. It's now 4.4 million pounds of an operating loss. Now they have, instead of 92 million pounds in net cash, because roughly around this time they likely acquired Topshop, they have 62.6 million pounds in net debt. This is not a company that I am very much too interested in. Yes, I like some of their products, and yes, I do think they are some competition to Boohoo. Their brands, as I say, are quite good, and the quality of the management is good, but what's going on here is not favourable whatsoever compared to Boohoo's 10 to 12% growth in revenue. Yes, they're all struggling in the industry, but that should not be a concern in the slightest. And yeah, and it says it here, really. It says that their key half two uncertainties are the impact on inflation on consumer discretionary spending, the impact of geopolitical risks on consumer sentiment, further supply chain disruption, as mentioned by Walter White earlier, due to lockdowns in China, and impact of pent-up clothing demand. Therefore, with this situation, all of this fear, I shouldn't be buying Boohoo, right? Well, I still am, believe it or not, and I'm looking at the wrong way of doing this. Let me just change that over here. I'm still buying Boohoo. I hold 13,472 shares, and this is something that I'm going to be increasing over time. Yes, I'm significantly underwater on this position, and that is acceptable to me because, as I've said before, and I've even said earlier in the video, I'm able to weather the storm. I can have a higher risk tolerance whilst you may not be able to. This is not me trying to flex on you. This is not me saying I'm better, because that's simply not true. What I'm saying here is that my unique advantage is that I'm able to take on a higher amount of risk, and whilst it may be dangerous to other individuals, this level of risk is sustainable, and I'm able to take this on because I provisioned for any eventualities that may go wrong, and therefore I am in a comfortable position where if quite literally shit hits the fan, I am therefore able to walk out of it and start again. The knowledge that can be learned from these mistakes, from the actions that are made right now, are critical in development over the longer term. And quite frankly, this whole portfolio can be wiped out. But ultimately, if I learn a crucial lesson from it, then that really means the most to me. Especially because if you think about it, yes, I'm invested in the stock market, I'm commentating on it 2 times a week, but that's not the only skill that I'm developing here. I'm also learning to run a business on YouTube. So there's more to it. That's for sure. If you liked the video and you'd like to know how to make £100 a month in dividend income, then click the card at the top right of the video. Thank you for watching. I'm Ozbourne Foreman. Have a fantastic week.